Our next guest says that what we are experiencing in the markets is a valuation correction. I want to bring in Megan Horneman, who is Chief Investment Officer at Verdence Capital Advisors. Megan, you want to explain what you're talking about?
Sure. Most of this year, we've seen valuations rise. It's been completely a PE-led rally, not necessarily an earnings-led rally. It's been in technology, growth, AI-related names. And this was all banking on the anticipation that the Fed would either be done this year, be cutting rates, or at least cutting rates in the early next year. And what we're seeing is that that's unlikely. The Fed has reiterated they're going to stay higher for longer. There's even a chance they may have to hike rates again this year. And we've been warning that sometimes the catalyst on a sell-off doesn't have to be a major event. It can just be a valuation correction where we have to get more realistic on what the valuation outlook looks like. You
also think that a recession could happen as soon as next quarter? Like next month, I guess I should say. Yeah, exactly. Fourth quarter or first quarter of next year. The consumer is our biggest concern. The consumer continues to be stretched. The credit card debt is getting outrageous. The rates are at record highs. And we're starting to see softness at all income levels now. So this is something that concerns us on how they can continue to spend money in the fourth quarter of this year, especially as we roll into next year and they start to pull back on spending. I mean, is that almost looking at what the Fed's done to this point and saying, OK, they've achieved their goal, they've slowed things down? Do you have any reason to think that this is going to be a severe recession, or is this just the type of slowdown that may be needed to tame inflation? Yeah, absolutely. It's a slowdown that has been Fed-induced, that's been needed. We've been talking about this since the end of the pandemic. We need to slow the demand side of it to bring down the price side of it. The Fed is achieving that side of it. The labor market remains stubbornly strong for the Fed. It puts them in a difficult situation. It's also one of the reasons why we think the recession that we do have won't be long, prolonged, or really deep. We think it'll be able to be short, shallow, and just a healthy correction in the market to get inflation down. The only other issue the Fed has to worry about right now is reigniting inflation with what we've seen with higher energy prices. That's one of the bigger risks we see, and we will see volatility in the inflation data over the next couple months. So there is a chance for a soft landing, or you think that that's out of the question? And a lot of people talk about a soft landing. What exactly does that mean? Does that mean no recession? I mean, I don't even like to really use that terminology. What we see is a recession, but we do see a short and shallow recession. And we think that that will be the opportunity where the consumer will pull back. We can get the Fed will be able to take their foot off the gas. The economy will slow. We'll get inflation where we can get it consistently down towards the Fed's objectives. But we just don't see it avoidable at this point. There's way too many factors. Remember, we still haven't felt the full effects of the Fed's tightening cycle, and we also haven't felt the full effects of the tight lending conditions from the banks. This is going to weigh on the economy going forward. You say you've been building your cash position all year, and it was the rally in equity markets that was really keeping you up at night. Are you ready to deploy some of that capital, and what is it that keeps you up at night now? It's getting close. I mean, we have seen almost a 10% correction in the broad market, more than 10% in some other areas of the market in small and mid cap. So we are looking at two things. We want fundamentals and valuations to come together. Right now, we still think that PE valuations on especially the large cap growth might still be a little elevated. But the fundamentals are just now starting to really weaken in the market. We're starting to see confidence again roll over. These are things that we want to see them come together before we want to deploy capital. The other thing we'd like to see is that earnings get a little bit more realistic for next year. Earnings are still looking for about 10 to 12% upside for next year. That's not likely given our expectation of a recession. What's keeping us up right now at night is the rapid move in interest rates and the rapid move in the dollar. When you see things happen at a quick pace like they have, over 100 basis points in a short period of time, it tends to uncover some weakness in other areas of the market, and we can't really pinpoint that at this point, but it does always end up resurfacing. Take the banking crisis in the first quarter of this year as one prime example. So if you are looking to potentially deploy some of that capital, where would you be targeting? Where are you thinking that maybe we're near the end?
So we'll look at the large cap growth area. We'll see if that does, like I mentioned, there's a little bit more PE valuation correction there. I think the small and mid cap space, that's always the area that rallies the most coming out of a recession. Markets will price in 6 to 9 months ahead. So we will look at that area as well. We've seen a bigger correction in that part of the market. Valuations are more attractive there as well. And then don't forget there is opportunities that's starting to emerge in the fixed income market, whether it's credit, investment grade, high yield credit. These are kind of the boring things that you can look at, but we'll look at both the equity side of the market as well as that fixed income side.